but in a more, a slower move down, where the leaders, the former leaders, are losing their momentum, which is what I expect to happen. And I think it's happening right now. You only have to look at Tesla, for example, and others. Then people start to look for other places to put their money. And that will mean smaller stocks. It'll definitely mean value. Value has underperformed growth, both among the big caps and also among the smaller caps. So it'll look for smaller cap, it'll look for value, and it will look for things that haven't performed. That includes gold stocks.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today, we're going to discuss all things economy, gold, silver, uranium, and resource stocks. And we're so fortunate to sit down with Adrian Day, founder of Adrian Day Asset Management, an asset management firm that believes in the merits of long-term global value investing, and that gold should serve as an integral part of a risk-averse approach. Adrian is a native of London, has spent many years as a financial investment writer, having authored 2 books on global investing. He's a recognized authority on both global and resource investing and is frequently interviewed by the press, both domestically and abroad. Adrian, thank you so much for joining me today.
Well, thank you very much for having me, Gary. I'm looking forward to this.
All right. I want to start at the macro picture. Most people on Wall Street, in the media, and in general, commentators speaking on the economy, they're in the soft landing camp because the economy is held together throughout the last few years. Usually when everyone is on one side of the trade, something else seems to happen. Do you believe something other than a soft landing is going to happen, or are you in the soft landing camp?
Oh, no, absolutely. I believe something else is going to happen. And 2 things are going to happen, in my view, that are contrary to the soft landing. First of all, we're going to have a recession. That, in my mind, is all but inevitable. It's as inevitable as anything in the investment field. And let me just look at that for a second. The fact that we haven't had a recession yet does not mean we're not going to get one. If you look back at all rate hiking cycles back into the 1950s, the beginning of the 1950s, you see that the average from the time the Federal Reserve first increased interest rates to the time of the onset of a recession, the average is 27 months. And even if you take out the outlier, there was an outlier of 50 months, take out the outlier, you're still at 22 months. Which means that we're just basically at the average right now. So the fact that, and obviously if it's an average, sometimes you go under, sometimes you go over. So the fact that we haven't had a recession yet does not in any way mean, from a historical point of view, that we won't get one. If you look at a lot of first of all, you look at the leading indicators of recession. The leading economic index is one. That's a very good predictor of recessions. I think it's predicted 4 out of the last 2. No, it's a very good predictor of recession. The other thing, when people look at it, the soft landing camp, they say, Janet Yellen herself said, well, when the unemployment rate is so low, you don't have a recession. That's just plain historically wrong. And she is a labor economist. She should surely know that. Even as Treasury Secretary, she doesn't know it. As labor economist, she should know it. You look at every single recession we've had back into the 60s now, so 9 recessions, the unemployment rate was at its absolute low immediately before the onset of a recession. It doesn't go low and then slowly get higher, then we get into a recession. And there's logical reasons for that we perhaps don't have time to get into now. So anyway, the indicators are pointing to a recession. The soft landing camp arguments, I think, are weak. The other argument, of course, is that consumers are still spending. Yes, consumers are still spending, but credit card debt is at all-time record highs, over $1 trillion of credit card debt. And not only is the debt high, but now we're getting defaults. And so we're getting credit card write-offs by the companies. When the company has had enough, you haven't paid for 1 month, you haven't paid for 2 months, you haven't paid for 3 months, they write it off. But credit card write-offs are now at 20-year highs. And you look at, yes, the consumer's still spending, but they're doing it on borrowed money. How long can that go on? So anyway, I think a recession is all but inevitable. And we're getting very, very close, in my view. I mean, I think by the end of the second quarter, it will be pretty clear that we're in a recession. Probably won't be called until the end of the year, by the National Bureau of Economic Statistics or economic research. The other part of the soft landing that I think is wrong, I'm not saying with such certainty, but I think it's wrong, is that we're not going to see inflation at 2% and stay at 2%. And I'm sure we're going to talk about that a little bit more. So on balance, sorry, just to wrap up, definitely a recession, and most likely recession with stubborn inflation, which is a stagflation. And in a stagflationary environment, we'll get to this later, but stocks don't do well. Developed market stocks, not just US, but stocks don't do well, bonds don't do well, gold does well, commodities do well.
So you touched in that answer, you touched on unemployment and how it's a lagging indicator and normally rises once the recession gets going. I read a study done by somebody, and they said that for every unemployment percentage point raised, so let's say we're at 3.7, goes to 4.7, that equates to about 700,000 jobs lost. Do you see a major uptick in this coming recession that you're talking about? Do you see a garden variety recession? Do you see a very heavy recession? Are we talking, 5 to 10 million people out of work here?
Right now, my base case would be for a relatively mild but stubborn recession. And the reason for that is the Fed's going to do everything they possibly can to minimize, and the federal government is to minimize the impact. And so I think it's going to be a long drawn out recession. Even if you go back to 2008, that recession should have been much sharper and much shorter, but it was only all the stimulus that was thrown at it that dragged it out so long. I think we're going to have the same impact here. But I think one of the important things to realize is, these things sort of, they snowball, they all come at once. So we didn't talk about it yet, but we know it's the lower half in terms of income and assets that are significantly hurting even now. And it's the upper, particularly the upper, 10 or 20% that are not hurting and are not hurting at all. So there's a huge discrepancy as what's happening. Now, when people start to lose their jobs, yes, you're going to have some investment bankers thrown out of work, but most of your job losses are going to be, in that lower half. That's the category that has the high credit card debt. And of course, what happens when you start seeing the unemployment go up, you start seeing the economy move towards a recession. Well, credit card companies, and you've got a lot of credit card debt. What do credit card companies do? They don't say, I know you're hurting, let me raise your credit limit from 10 to 15 so you can afford to eat. No, they say, you're at 10,000 and your limit's at 10,000, we're going to cut your limit to 8,000. And so people have no cushion. And of course, there's no savings among the lower half. So there's no cushion, and it's going to get, in my view, very ugly for that lower segment in terms of income. I keep saying lower, that's not a moral. I think that's obvious, right?
I understand what you're saying.
The lower half in terms of assets is going to get very ugly very quickly for them.
So do you see a UBI or some kind of stimulus coming back in to help those folks, or do you think it's just going to be sink or swim for them?
No, no, no. We're definitely going to get the stimulus. We're going to get the stimulus from the Federal Reserve. And we can talk about them in a minute, but we're going to get stimulus from the Federal Reserve, and more importantly, we're going to get increased stimulus from federal government and deficit spending.
So when the Fed cuts rates, they're not normally doing that because the economy is doing well and because everything is fine. So especially in this case, with the rates having been so low for so long, um, more than likely the Fed, when they cut rates, it's going to be because there is a major problem in the economy. So when they cut rates, the markets are falling. Do you see a rotation at this point when they start cutting rates, the economy and the markets are falling? Do you see a rotation into safety plays at that point, such as gold, coming in that kind of environment?
Yeah, yeah. Well, we're sort of skipping over all the stuff you said about the Fed and just moving to the market. Yes, a couple of things. I'm not sure. I don't think, again, my base case, I don't think we're going to have a market crash. We're going to see rotation, as you mentioned. We're going to see rotation out of the not quite so magnificent seven. And if you see the market down a little bit, people will tend to sell those huge wins they have but are looking a little bit uncertain, and they'll look for other sectors in which to put their money. You know, in a crash, it's different. In a crash, people start to look for liquidity and they sell whatever they can sell that has bids. We saw that in 2008, we saw it in 1997, etc. But in a more, a slower move down, where the leaders, the former leaders, are losing their momentum, which is what I expect to happen. And I think it's happening right now. You only have to look at Tesla, for example, and others. Then people start to look for other places to put their money. And that will mean smaller stocks. It'll definitely mean value. Value has underperformed growth, both among the big caps and also among the smaller caps. So it'll look for smaller cap, it'll look for value, and it will look for things that haven't performed. That includes gold stocks that you mentioned, and that are cheap and that haven't performed. Gold stocks would be one, oil stocks would be another. So, yes, I think we'll start seeing some money flowing into the oil stocks. I've said for a while, people say to me, gosh, gold is up, and we can talk about that in a second, but gold is up, the stock market's up, and yet gold stocks are going down. And I've always said gold stocks don't necessarily move when the broad market is up. Gold stocks will start to move when the stock market stumbles, in my view.
Oh, that's interesting. So that was a question I was going to ask you a little bit later. But so what you're saying is that if and when this recession that you're talking about shows up, you would not sell gold mining shares at that point. You think they're going to actually perform okay to well during a recession scenario. I'm just thinking of like during the Great Depression when home stake mining went up 600%, their dividends skyrocketed. I'm not necessarily suggesting that we would have a similar setup to home stake mining in the 30s, but are you saying hold the miners through a recession?
Yeah, definitely. And of course, the 1930s was a special case because gold was outlawed. So people who wanted gold had to buy gold stocks. But yes, I keep saying if you look at, I think it's important to look at how things have acted in similar scenarios. History doesn't repeat, but it does rhyme, as Mark Twain famously said. And I think economic history is very important to look at history. So if you look at all of the recessions back into the late 1960s, so we're looking at 9 recessions in the US back to the 1960s. Gold has gold has gone up in every single one of those except one case,
Right.
which was the 2000s when the European banks were dumping their gold, if you remember that. And they introduced the stabilization program. And even in that recession, gold was down less than 0.5%. So gold has typically done well during recessions. Gold stocks have gone up in more than half of those recessions. And in the ones where they were down by 2%, 3%, 6%. In the ones where they were up by 30, 50, and even 140%. So yes, on average, you want to be holding your gold stocks during a recession. And the other point I'll make is that gold stocks have outperformed the S&P. Even when they were down, they still outperform the S&P during recessions. Again, in every case except one, they outperformed. So yes, you want to be holding gold and gold stocks during a recession, particularly if you have stubborn inflation along with the recession. So a stagflationary environment is the ideal environment for gold.
So I'm glad that you just brought up inflation, because I was going to ask you a question. I'm sure this morning you saw that inflation is showing to be higher than expected. Are you believing that they're going to whip and tame inflation? Or do you believe that moving forward, we're in for a more prolonged period of time of inflation, similar to the 70s or the 40s?
Yeah, no, I think gold is, I think inflation is, the word I use is stubborn. Doesn't necessarily mean that I think we're going to see it at 8, 10, 15% anytime soon, but I think it's going to remain stubbornly above that 2%. And the 2%, of course, is just an arbitrary number. The Fed, actually, I don't know if you know how that came about. That came about with the Central Bank of New Zealand, National Bank of New Zealand, 15 years ago. And the guy was saying, we want to get inflation down. It doesn't have to be at 0, but we've got to get it down. And a reporter asked him, well, what do you think would be an acceptable number? And he said, yeah, we just need to get it down. You know, it doesn't have to be at 0. Yes, but what would be an acceptable number? And he just threw it out. 2%. And suddenly 2% has been adopted by central banks around the world as the goal for inflation. So it's nonsense and it's arbitrary. But I don't think they're going to get to that 2% number. I mean, you look where we are now, you know, depending on whether you're looking at CPI, core CPI, PCE, core PCE, whatever, but we're anywhere from 30 to 60% above their target right now. So we're a long way from their target. I would say in this environment, if in the near future, we see the inflation rate, however you want to define that, the inflation rate meaningfully and sustainably under 2%, that will be a sign of severe trouble in the economy. So I don't think we should be routing for that. So yeah, I think we're going to get above 2%. And let me just say a couple of things about inflation. You know, it's not a surprise to me, I have to say, and I've been saying this for the last several months, it's not a surprise to me that inflation is picking up. I didn't know that today, you know, January's numbers were, this week's report was going to be so high. But looking at March, April, May, June, I think we're going to see higher numbers. And there's two main reasons for that. One reason is you look at what the oil price has done since November, middle of early November. You know, the oil price is up 10, 12%. Still lower than I think oil, quote, should be, right? Which is not something you should ever talk about in your markets. You shouldn't say what the price should be. But anyway, but it's up 12% after coming down significantly. That decline in the price of oil from the middle of last year to the end of October is one of the factors that really helped the inflation numbers come down, because oil doesn't just go into obvious things like gasoline and transportation or air transportation and so on, but it goes into the price of every good in the store. Because, of course, every good in the store is shipped from somewhere, even if it's only the farm that's 10 miles down the road. And these days, of course, there's very little stuff shipped from the farm just for 10 miles. So as the price of oil has moved up, I've been saying now for a couple of months that will translate into higher prices in the stores, you know, in the coming months. The other major factor, frankly, is you look at health insurance. Now, health care overall, which includes insurance, and a major part of healthcare is insurance in the US, healthcare overall is the largest weighting in the core PCE. It's the largest weighting. Over the last 12 months, at the end of the year, somehow mysteriously, the Bureau of Labor Statistics or whoever it is who calculates the CPI, but somehow they mysteriously said that the cost of health insurance in the United States had declined on average 34%. Right. 34%. I don't know a single person in the United States whose health insurance costs went down 34%. Mine didn't. They are having to adjust that because it was clearly wrong. It was clearly false. And as a tangent, one of the problems we're seeing these days is that more and more government statistics, when they come out, are just plain wrong. Yeah. And, you know, the people who calculate them know they're wrong, and they have to sort of slowly come back and adjust them. We see that with the new jobs numbers, right? That's a different issue we get, you know, but if you look at last year, from January to December, they have a first revision and a second revision. You look at those revisions, the revision was negative 470,000 jobs compared with the initial report. And of course, it's the initial report that gets all of the publicity. The first revision gets very little, and the second revision, most people don't even know there is a second revision. Right. So that was a big tangent, I'm sorry. So inflation is going up, A, because of oil, but B, because they're going to have to get the health insurance number back to reality. And in fact, health insurance was up in these numbers today. It was one of the largest increases today. And that's going to continue for a few more months because they have to get that back to reality. So if you look at A, oil, and B, health insurance costs, you know, I think just those two alone will see inflation moving back up.
Yeah. And, you know, something that's lost on so many people or not spoken about enough is that in order to get back down to an average of 2%, since we've been elevated so high for so long, we have to go well below 2% for an extended period of time to return the long-term average to 2%. And just as a sidebar, quite frankly, my goal or my perfect inflation number would be 0.
Yeah.
You know, and I think most people feel that way.
Of course. I mean, that's normal. And a healthy, what I call a healthy deflation, everybody thinks deflation is bad. Of course it's not. We think inflation is bad because the last major deflation in the United States was in the 1930s when we had a depression. So most people think, oh, deflation equals depression equals bad. Right. That's not true. You've got 4 different things. You've got growth and recession. And then separately, you've got inflation or deflation. And it just so happens that the last time we had deflation, we had a depression, but you don't have to have that. And I like to point out to people that England, or Britain, I should say, from the end of the Napoleonic War, when we whipped the French in 1815, to the eve of the First World War, when we whipped the Germans with some help from America in 1914, that's a whole century. It was a century of deflation. The pound in 1914 bought more goods than it did in 1815.
Wow.
And yet that was a century of great, incredible economic growth for Britain. So deflation in and of itself is not a bad thing.
That's wonderful for consumers.
Of course, but the Fed, if anything, should be targeting 0. You're right. They should be targeting 0, and then productivity and technological advance will take care of moving prices down.
Exactly. So, okay, so let's move over to gold if that's okay. It's been said that gold will begin its big move up when the market believes that the Fed's going to cut rates without taming inflation. So the Fed has managed to hold rates higher for longer, well longer than most believe that they would or even could, and it looks like it's going to stay higher for longer as the market is adjusting how many rate cuts they think are coming in 24. Every time the market thinks a rate cut is coming, it just hasn't, and it seems like it's going to take a massive move down, some economic crisis in order for that to take place. Since the market is forward thinking, what has to happen in order for the markets to finally believe that the Fed's going to cut rates?
Yeah. Well, as you said at the beginning, I've said for a while that the market has to believe that the Fed is going to cut rates before they quashed inflation. And the second part of that clearly is still true, but now, as you say, the markets have pushed out. I mean, I thought the market was overly optimistic, in the last quarter of last year, and frankly, Fed's Jerome Powell's press conference in December didn't do anything to calm those expectations. But yes, it's clear now that the market is a little more realistic about when rate cuts will come. The difficulty from the Fed's point of view is that I don't think they can cut rates for the first time at the last meeting before the election. That just looks too political. Jerome Powell in particular, the Fed generally, but Jerome Powell in particular likes to say, we're not political, we don't even think about the election, and so on and so forth. Maybe they don't want to cut rates to give the incumbents any kind of support, maybe. But I think they definitely would not like the image of cutting rates for the first time at the last meeting before the election. What that means is that if they're going to cut rates this year, they're going to have to do it at the June meeting. July? Sorry.
You're fine.
I think it's July they meet. At the July meeting, they're going to have to do it at the July meeting if they're going to do it this year. Already the May meeting, as you indicated, the Fed funds futures is I think down to 36% last time I looked for a May rate cut. But two things could happen. I don't think the Fed is overly concerned about the stock market going down unless it crashes. I don't think they're overly concerned about that. I don't think they're overly concerned about broad deterioration in the market. But if we see unemployment move up meaningfully, and Jerome Powell indicated this at his last conference, if we see unemployment move up meaningfully, I think they'll want to ease. And also, of course, if we have something break, as they say, if we have something else break, it's very significant, I think, and didn't get enough publicity. But in their rewrite, in January, they basically rewrote their statement.
Yeah.
Because for the last 2 years, every statement was just a tiny little tweak on the last one. Take out extremely and put in very. They were just tweaking. The last one was a bit of a rewrite. And one of the things they took out was the US banking system remains very solid. They took it out.
Right.
Why would you take that out unless you really thought it wasn't solid? And so we could easily see a situation where a bank, maybe even a major bank, Bank of America, right, was asked by the regulators to recalculate how they assess the strength of their counterparties on their derivatives. A major bank issue would cause the Fed to ease.
Yeah, and aren't they? I'm pretty sure they said that they're not going to re-up the BTFP program in March, and so we're coming up on the 1 year anniversary. Those folks not only are still holding those same assets, but now they have the loan to pay in addition.
Right, right. And it's funny because for most of last year, the Fed was urging banks to use that facility. They wanted banks to use that facility, even if banks didn't really feel they needed to.
Yeah.
But
So
yeah,
yeah. So all right. Well, we should be looking for something. I would say since they did remove that from the language, it's curious as to why they removed it, as you just pointed out.
right.
Yeah.
But just before you asked me, sorry, you did say gold and rates. So it looks likely. I mean, a March cut would be very would be highly unlikely at this point. May, I think, is still a possibility. Depends on how the numbers come in between now and then. But I don't think the inflation numbers are going to come in the way that the Fed wants. So, from the point of view of gold, and we saw it in gold's reaction this morning, of course, under 2000 now. Gold is going to be looking for a clear indication that the Fed is going to be cutting soon. And we're not at that point now.
Yeah, so that's a really good segue for this question. You had pointed out that 8 of the last 9 recessions, gold took off. What is the what do you need to see, or is it as simple as the Fed is going to start cutting rates? What do you need to see for that same outcome to take place? Is it as simple as the Fed is beginning to cut rates?
I think that's the central and most important factor. Yes, the Fed and other central banks are going to cut rates because it's not a recession that is good for gold. It's the central bank's reaction to a recession that's good for gold. And that goes back to your comment that markets are forward looking. Yeah, I think that's the central factor. Now, the other factor, of course, that can play into a recession is and higher interest rates, is if we have things start to break. You get banks, particularly if you had a major bank get into trouble, then people go to safe havens. They go to the dollar and they go to gold. Mm-hmm. So, and global investors, I think, with everything the US is doing, to weaponize the dollar, I think we're going to see a bias towards going to gold compared with previous safe haven incidents. So yes, it's a recession, meaning the Fed will cut rates, good for gold. A recession meaning some things will start to break, good for gold.
I think the point you just made is so important and cannot be understated enough. I don't think the majority of the public understands that treasuries are not looked at as the same around the world as they were, over the previous 40 years.
Absolutely true. And, you look at, say, let's just go back 10 years. You look 10 years ago, and you'll go, who are the biggest buyers and the biggest holders of treasuries? And the perverse thing is the Federal Reserve is the largest holder and was until a year ago the largest buyer, or 18 months ago, the largest buyer of treasuries. That in and of itself is just a perverse. Only a PhD in economics can wrap their head around that concept. But one arm of the government creates money to buy the debt of another arm of the government. And somehow everything about that is good. But anyway, the Federal Reserve was the largest. They're not buying anymore. China is the second. Well, foreign holders generally are the second. Well, of the foreign holders, China, Japan, and Russia, who are the big three 10 years ago, they're not buying anymore. Russia certainly isn't. They've sold everything.
Yeah.
China is now a net seller, marginally, but a net seller. But they're certainly not going to be a major buyer. And Japan, as their rates start to move up, They start to move up slowly. I think, what are they now? -2 and -1/4. That's a very strong interest rate for Japan. But as their rates start to move up and the yield curve control comes off slowly and the economy starts to improve a little bit, well, the money that the Japanese institutions put overseas for the last 40 years, that's going to start coming back home. So those three major buyers aren't there. The banks were a major buyer and holder of US Treasuries. They're less so now, particularly at the long end, because of all the problems we saw with Silicon Valley and the other banks last year with the mismatch between their loans and their assets. So they're less likely to buy. So who's going to be buying, particularly the long dated? There's a big difference between the long dated treasuries and the short dated. You know, if you can get 5% on a 1-month T-bill, well, in the current environment, that's not a bad place to put your money, frankly. And a lot of people are doing that. We're doing that with some of our assets. But the long end, who wants to buy a 30-year US government bond right now? The only people who are buying, and what is it, 4.75%? You know, that is just simply not, on a rational investment analysis, that is simply not rewarding you for holding US government debt for 30 years. So the only people buying US government debt are people who are sort of more or less obliged to, like pension funds and insurance companies, and frankly, hedge funds and speculators who are thinking, we'll get a bit of a dip and I can, in rates, and I can sell my thing at a profit. But they're not thinking of holding for 30 years.
Yeah, and I think, you spoke on the demand side. Well, on the supply side, if we go, it seems like global growth is slowing down. If oil stays elevated or goes much higher, which some are predicting, some of these countries are going to have to really sell off some of these assets further in order to raise the cash to go out and help their economies and buy that energy, Japan being one of them.
Well, they're certainly not going to roll them over as they've done in the past. They're going to let them mature, that's for sure. Yeah.
So the central banks have been buying record amounts of gold the last 3-4 years, while Western investors are really not buying gold at all. So there's a really large disconnect between the price of gold and gold stocks. Can you speak into this, and what do you see that has to happen in order for gold stocks to catch up to the price of gold?
Yeah. Well, the first part of the question you've really already answered. You have to look at people, as people often say, well, gold's going up, why aren't the gold stocks? Well, look at who's buying gold and why they're buying it. And as you mentioned, for the last, really, I mean, as you say, for years, but particularly the last 18 months, it's 18 months now, central banks have been buying at record levels at the same time as particularly Westerners, institutions and retail haven't. You look at ETF holdings, for example, and for the last 18 months, they have been almost consistently, not every single month, but pretty consistently, we've seen outflows. We've even seen outflows in the last 2 months. We've seen steady outflows. So whether gold's going up, we see outflows. Whether gold's coming down, we see outflows. So US and Western institutions are not buying gold. Retail is not. You look at the coin premiums, which will be a good indication of the demand for coins. They've come way down, and the coin dealers I talk to say that the demand for coins has gone down. So if you look at who's been buying, and other than central banks, it's been primarily very wealthy Mideast families and Asian families. Look at who's buying, and why are they buying? They're buying for long-term defensive insurance, right? And if you're buying for long-term insurance, you buy physical bullion. Mm-hmm. You don't buy consolidated Ajax or amalgamated moose pasture. And so the people who are buying and the motives for which they're buying are pointing towards people buying gold. And so to me, that really explains that huge disconnect between gold and the gold stocks. The gold stocks, in my view, need two things to happen. They need gold to move towards the 2100. It's moved towards there a couple of times in the last year. And when it did, the gold stocks reacted, but it needs to move towards 2100 and sort of start to hold there and move above 2100. And I think, frankly, it also needs, as I said earlier, a wobble in the stock market so that you start to see some rotation from the leaders towards the things that haven't moved. You know, those two things in tandem, and they'll probably happen in tandem, we'll see the gold stocks start to move up. And, you know, as I've said, and what I'm about to say was also true a month ago and 6 months ago. But the gold stocks, I have to say that, the gold stocks are just incredibly undervalued right now. You look at a company like Barrick, the second largest gold mining company in the world, is trading at its lowest price to net asset value in its history. You look at Agnico Eagle, which doesn't have all the political risk of Barrick. You know, people say, oh, well, Barrick's this, that, and the other. But Agnico Eagle isn't this, that, and the other. It's a great company with great assets in good jurisdictions, blah, blah, blah. It's selling at its lowest ever price to cash flow, except the last quarter of 2015, the lowest ever price to cash flow in its history. And yet gold, okay, now it's just under 2,000, and the short-term outlook doesn't look so good, but gold is still relatively high, and the longer-term outlook is still good. The margins are pretty robust. I mean, they're not the highest ever, but if you've got an all-in sustaining cost of 1,200 or 1,300 even, and you're selling it at 2,000, that's not a bad margin at all. And so the gold stocks are undervalued. They're in a good position as companies. The prices are just ridiculous in my view.
Well, let's stay on this topic here with GDX and HUI. So they do appear incredibly undervalued. GDX is trading at the same value as it was in 2013. Same with HUI. GDX at 1275, HUI at 218. The indexes really have flatlined. You know, they haven't moved in 11 years, despite gold going up 40%. You know, a 40% move up for gold from here would put gold at 2,800. What's going on here? Are the gold miners not running their business as well? Have investors completely abandoned gold stocks without good reason? What has happened really to create this incredibly undervalued situation?
Is that a leading question? Yeah, I mean, I think there's a lot going on. And what I was talking about is really what's been going on for the last 18 months. But on a more fundamental basis, yes, generalist investors have really abandoned gold. It's not that they're negative on gold, because negative implies you're looking at the current situation, you're negative, but they're just not interested. They've lost interest in gold. And frankly, for good reason. And I like to say when I started in this business, and even up until the early 2000s, before gold took off, you could look at any fund you wanted, you know, a global value fund or a US growth fund or whatever, and they all had some gold exposure. If you look at mutual funds today, other than dedicated gold funds and the First Eagle funds, good old First Eagle, nobody has gold in their portfolios. I mean, nobody has gold in their portfolios anymore. And the reason, yes, to answer your leading question, is because people have lost confidence in gold stocks, and with very, very good reason. First of all, just look at the stocks and the price. Newmont is trading at a lower price today. The largest gold mining company in the world is trading at a lower price today than it was in 1996. Barrick is trading at a lower price today than it was in 1996. And the dividends are hardly what you'd call, or have been until very recently, they've hardly been enticing. So is it any wonder that the generalist who doesn't really follow the market, doesn't really understand, he just wants to buy a couple of the biggest companies, is it any wonder that they've lost interest? And then you mentioned 2013. You look at what happened in 2011 and 12 when gold was last time at these record levels. And the industry went on this crazy splurge of overpaying for for marginal assets. And the excuse they gave was, well, our investors want us to grow, our investors want us to grow. And there was this sort of feeling, we all have it as humans, but we extrapolate, right? And well, if gold's gone from 250 to 20, over 2000, it must be going to 3,000 pretty soon. And so people were scrambling to buy whatever was available, and they were overpaying for marginal assets. You look, so that was 2011-12 at the peak. You look at the 2 years after that, the major miners had written off, not written down, written off over 75% of every, I'll call them investments in quotes. I don't know what other word to use than investments, but over 75% of the money that they spent on acquisitions in 2011 and 2012 was written off within 2 years. And so if you're a generalist, you say, this is Mickey Mouse. I don't need this in my portfolio. I don't follow gold, so I don't know it. It's like me, I don't follow technology. But if I wanted technology, I say, oh, well, let's buy Microsoft, right? Must be good. But so that's what people were doing here, buying the biggest and supposedly best. And the XAU collapsed 86% in the next 4 years, from 2011 to 2015. If you're a generalist, you just don't want that and don't need it. So what did they do just to put a little bit of icing in the cake? They said, well, look at this Franco. That has a different kind of business model and looks good to us, and the balance sheet is good. And gosh, look at the stock chart from 2009. Wow, let's buy Franco. We can sleep easy with Franco. And then, of course, not Franco's fault, but they had that mine in Panama confiscated. And the stock collapsed over 25%, in 3 months. And the generalist said, enough. I've had enough of this stuff. So it's going to take a while before generalists come back. But we all know what makes people want to buy something is when the price has gone up. Exactly.
Yeah. Yeah.
So when the price is over 2,100, they'll all be coming back. We know they will.
Yeah, and I'm sure even on top of what you just shared, which is some very important history there and psychology, ESG and carbon neutral policies have probably played a role. And there's probably, other factors, for instance, the vortex of the Mag 7, just pulling so much investment dollars and attention over to them and away from other sectors. So
yeah, no, absolutely.
Yeah. So gold production has been falling for a period. Every time global production has declined, gold price moves up. I'm not suggesting at all that we're running out of gold, but I am interested to hear your viewpoints on gold production falling and a subsequent period of rising prices.
Yeah, well, no, you're absolutely correct. But the history is that every time we get that declining gold production on a global basis, gold prices move up. And that's sort of logical. We can all understand that. It's absolutely true. But for the last 40 years, this isn't a short-term trend. For the last 40 years, the number of new discoveries of gold, and particularly the number of large discoveries, has declined. Not every year, there's ups and downs, but if you look at it on a 3-year basis, it's gone down for the last 40 years. And, recently, we simply have not been discovering what we're producing. So that in and of itself is a recipe in the long run for higher prices. I'll repeat that. We are not discovering what we are as an industry producing. Add to that the fact that grades have been consistently coming down over 40 years, slowly, but coming down. And new discoveries tend to have lower grades than discoveries of 20 and 30 years ago. But as you indicated, that's not to suggest the world is running out of gold anytime soon, or that companies are running out of gold. Again, look at a company like Barrick. For 3 years in a row, they have organically increased their reserves, not by buying anyone, but just by discovery and by mostly brownfields, but they've increased their reserves 3 years running. And you look at most of the major companies, whether it's Gold Fields or Barrick or several of them, they've got decades of reserves and resources ahead of them. So, so there's no indication that the major miners are going to run out anytime soon. But again, a lot of those are resources. You look at a company like Barrick, I mentioned they've increased their reserves 3 years running. Their resources actually declined last year when they did their year end. Resources, as you know, are ounces in which a company doesn't have as much confidence that they will be produced. With a reserve, you have a very high degree of confidence that those ounces will be produced. And so in the resource category, you might have things where you simply haven't done enough drilling, enough infill drilling to give you the confidence. Or it might be jurisdictions where you're concerned whether you're ever going to get the permit, for example, like with Barrick, Pascua-Lama. It might be places where mines where you need a higher price of gold, like for Barrick, for Donlin, which is a large deposit, but it's in their resources. And so almost half of Barrick's resources, which are 77 million, but almost half of their resources are in mines where they have not announced any time frame for production, and they're not in their 10-year guidance. So what does that mean? Does that mean none of those ounces will ever be produced? No, of course not. But it means they're not going to be produced imminently. And so large companies that are producing 3 and 5 million ounces a year, if they're not discovering, and Barrick is a bit of an exception in that, if they're not discovering them, they have to buy them. And we've seen that obviously in the last couple of years. We've seen Agnico, which is one of the most conservative and one of my favorite, but they bought Kirkland, and Newmont, of course, just bought Newcrest, and we've seen other acquisitions, a bit lower down the food chain. And I think you're going to see that continue, because if a company's producing 5 million ounces, let's say, and they're not discovering 5 million, they're going to start looking for someone to buy. It's not a matter of, in most cases, other than Newmont, it's not a case of buying to get bigger. It's a case of buying to stay where you are.
Yeah. So it sounds like you see a period of time of mergers and acquisitions ahead. Maybe not like as extreme as the early 2000s, but a period nonetheless, so that the majors can restock some supply here.
Absolutely. And again, the sort of, and it's not really an irony when you think about it, but that will pick up, not when prices are really low. People say, gosh, look at this, it's so inexpensive. Why doesn't someone buy it? Well, but you'll see that merger and acquisition pick up when prices move up. Mm-hmm. Generally, I mean, that's when they have the money to spend, they can raise the money. In a market like this, companies find it difficult to raise money to make acquisitions. And the other thing I'll say is that, it depends whether you're talking Agnico buying Kirkland or Newmont buying Newcrest, or you're looking further down the food chain. But typically, when a major company is interested in a project owned by an exploration company, they want the exploration company to de-risk it completely, not just geologically, metallurgically, but they want to de-risk the community relations and de-risk the permitting. They would much rather pay up for a project that's already been de-risked. And as we know, around the world in many places now, it's just taking longer to de-risk projects from the permitting and political social point of view.
Mm-hmm. So I want to ask you a question regarding the dollar and gold. They've typically moved inversely to each other. Yet the dollar, the dollar has been stronger in recent years, and gold has actually held up fairly well during the same time frame. Do you see the dollar weakening in the months and years ahead